It's the midweek edition of Business Morning. Good morning and welcome. I'm Ini John Mekwa.
And I'm Ladi Williams. Let's take a look at what's in the news. Abuja, the nation's capital, is again witnessing long queues at petrol stations as motorists lament difficulty in purchasing petroleum motor spirit, otherwise known as petrol. The Group Managing Director of the Nigerian National Petroleum Corporation, Malam Melek Kyari, is assuring Nigerians that the queues will diminish soon. Mr. Kyari explains that the NNPC had intervened to resolve the planned industrial action by the petroleum tanker drivers against their employers. Do take a listen.
Long queues of vehicles waiting for petrol at the NNPC petrol station in Guzape. Some motorists have been on the queue since the early hours of the day, with the hope of getting the product fading by the hour.
I've been here for like 3 hours, and we cannot move an inch, and we are still hoping we can get for before the day runs out.
3 hours, it's not been easy, to tell the truth. It's not funny. And one thing about this one is that I never even heard there was going to be any inflation, any increment in price. I never heard there was going to be any strike. I just, was just passing since yesterday. It's just been crazy.
Since 7 o'clock a.m., I'll be here. I think that is to 2 now. If there is increase, if you buy and go, nobody's crash your car. Then you stay, at the end of the day, see buy, somebody's crash your car. If they scratch this car now, maybe before I can put it in order, it's not an easy thing.
Black markets traders are having a field day as commuters continue to wait under the scorching sun to get the product. The queue is causing heavy traffic along some of the major roads.
Looking at the environment, you know that we are not finding it easy to access fuel. And looking at the weather also, the weather is hot, the place is hot.
They only give some of the people that they know them. Some others come through back, but we will be in day queue. Few of us, they allow us to enter. As you can see, if Adimi, they allow people here enter, this place will not remain like this.
Meanwhile, the Group Managing Director of the Nigerian National Petroleum Corporation believes the situation will relapse in less than 24 hours.
These queues will go away because there was industrial action by petroleum tanker drivers against their employers, the National Association of Road Transport Owners, around their compensation package. And those issues were not resolved up to yesterday until we intervened to ensure that there's an amicable settlement between the parties so that they will have peace, and then normal loading operations will commence from the depots. As I speak to you this moment now, loading has commenced in all depots in the country. Dispatches of trucks are ongoing in all depots in the country, and they have called up the strike for a period of 1 week so that enable us to intervene and find resolution.
The NNPC is assuring Nigerians that there is no plan to increase the price of petroleum product in May.
And lawmakers in the upper chamber of the Senate have passed through a second reading, a piece of legislation which it hopes will sanitize the livestock industry and address the persistent farmers-herders clashes, as well as cattle rustling in the country. During Tuesday's legislative proceedings, the upper chamber is proposing a bill to establish the National Livestock Bureau for the purpose of livestock identification, cattle rustling control, registration, and livestock disease control. Deputies and appointees who fail to deliver the dividends of democracy.
Livestock identification, ID, refers to keeping records of individual farm animals or groups of farm animals so that they can be more easily tracked from their birth through the marketing chain to the table. Despite Nigeria having about 40% of entire cattle population of West Africa, the country cannot participate in the export of meat and other dairy products due to the absence of a functional animal identification and management system in Nigeria. Furthermore, the movement of livestock and other products has increased the spread of diseases, increased the threat to human health, and reduced consumer confidence in animal products. The Bureau, when established, will ensure the traceability of animal products into the country in order to safeguard the lives of our people. When passed into law, the bill will address the following objectives. Number 1, creation of a national livestock identification database. Number 2, ensure management, traceability, and control of movement of livestock. Number 3, ensure livestock health and disease management through disease surveillance, prevention, and quick response to disease outbreaks.
And owners of micro, small, and medium-scale businesses have been challenged to deploy the use of intellectual property rights in their business to get value for funds invested. The acting head of the World Intellectual Property Organization, Mr. Oluwatobiloba Moody, who was speaking at a news conference in Abuja, explains that businesses can be strengthened to combat unfair competitive practices. On his part, the Director General of Small and Medium Development Agency, Dr. Dick Orada, is promising a synergy with owners of small businesses to improve their knowledge on property rights.
On the global scale, SMEs also make up around 90% of the world's businesses and employ around 50% of the global workforce, generating up to 40% of national income in many emerging economies. Now, while all these business ventures typically take an idea, mix it with ingenuity, and create a product or a service that consumers want, many, as the DG has rightly mentioned, remain unaware of that they hold intellectual property or that it even has value. And this means that many are missing out on opportunities to improve their bottom line and to grow. Now, studies have shown that when businesses are IP savvy or understand their rights, they are able to acquire and are able to acquire and manage their IP rights, they do even better. Now, IP commercialization is at the heart of this year's World IP Day celebration. And it therefore serves as a call to the attention and a call to the challenges that DG has mentioned that are faced by SMEs in our local economy and even maximizing their full business potential.
And oil prices fell for a second day on concerns that soaring COVID-19 cases in India will drive down the fuel demand in the world's third biggest oil importer. Brent crude futures for June fell 52 cents to $66.05 a barrel in early trade after dropping 48 cents on Tuesday. U.S. West Texas Intermediate crude futures for June fell 56 cents to $62.11 a barrel. The May contract expired on Tuesday, down 1.5% at $62.44 a barrel. The U.S. Energy Information Administration will release its inventory data for last week later today. And analysts say despite the pandemic hotspots in places like India and growing concerns in Japan, the world's fourth biggest oil user, signs are still positive for a fuel demand recovery in the United States, UK, and Europe.
Well, still talking about oil, but now we come to Nigeria, where the NNPC has assured Nigerians that there would not be an increase in the price of PMS in the month of May. This is in the wake of ongoing talks between the federal government and the organized labor on PMS price modulation and electricity tariff in the country. Last month, the Group Managing Director of NNPC, Mr. Melekari, noted that the corporation pays between 100 billion and 120 billion naira a month to keep the pump price PMS, which is petrol, at the current levels. According to him, the landing cost of petrol with current fundamentals comes at 234 naira per litre, but the corporation sells the product at 162 naira per litre. It puts daily consumption at 60 million litres, all imported by NNPC. Well, it's not a new topic, but it's one which is still sensitive. The removal of subsidy and the current economic issues. We have Mr. Oji Udemezwe, the managing consultant of Flame Academy and Consulting Limited, talking to us about that now. Good morning, Mr. Udemezwe. Thank you so much for making time to be with us this morning.
Good morning, and thanks for having me. Always my pleasure to join you guys on this program.
Thank you. Well, the talk between the federal government and Labour seems to be taking a long time, you know, and every month we have to wait for the NNPC to tell us, oh, this month there won't be an increase. The talks are still on. What do you think are the considerations that at this long meeting?
This battle of fuel price determination in Nigeria will likely be a battle without end. It's very unlikely that the Labour or the organized labor in Nigeria will ever come to that understanding that subsidy removal will mean that fuel prices will have to fluctuate in line with the global oil prices. That understanding hasn't sunk in properly. And until the organized labor are properly given that tutoring and a proper understanding of that expectation, and of course, followed up with some level of confidence building and trust building, the federal government, more than ever before, is now pushing out policies to improve the life of the ordinary Nigerian, the public servant, and all the workers in Nigeria, and that has to be seen clearly. This fight of mistrust will continue without end. There is no doubt, of course, that removal of fuel subsidy will be healthy for the running of Nigeria's annual budget. That removing this fuel subsidy will free up unnecessary expenditure that is always done, trying to subsidize this product, trying to fund the importation of this product that has remained a major undoing to this economy. When you remove subsidy, you allow the product to move in line with market price. And it's going to be, in the long run, it's supposed to be a good thing for this economy to, to relieve itself of this burden of always subsidizing this product. And of course, you know that when fuel is being subsidized, the lifestyle of the bourgeois, all of us who have been privileged in this economy, is being subsidized. And funds are being taken away from, other areas of the economy that will help the common man in the country. So it's a good thing to remove the subsidy. But then, as you do that, there are consequences that will come with it. Prices will go off the roof. And once transportation price goes up, every other thing, every single thing, from garri to tomato to orange to the higher things in the market, their prices will also push further up. Already we are seeing a very huge price push in the market. Inflation is going off the roof. Food items are going up, worsened by the insecurity in the country, where farmers are retreating from their farms because of the herdsmen and banditry attacks and all of that. And then the fact that we are seeing the worst value of our currency, which is pushing up the cost push inflation, off the roof. Inflation is approaching 20% and might hit that in a few weeks. So, so looking at this, removing the subsidy to help the economy run better on its budget, and the fact that removing it will worsen prices and further damage the already poverty, stricken population of this country. So it's a very tough situation to be in. So NNPC may have to carry that burden a bit more longer, or until we find that convenient trust position where we can allow them to remove it totally. So it seems to me that fuel subsidy may remain, to remove or not to remove for a while. Total removal may not work at this point, no matter how good the policy intention could be.
All right, Mr. Adumezwe. Well, OPEC Plus decision to ease the supply cut agreement, the oil market has remained largely bullish on the back of improved economic activities across the world. Since the beginning of the year till date, Brent has gained over 29.4%, leveraging on the growing demand for crude oil. The recovery in oil price, bodes well for the FX market as the CBN has begun to intervene in the I&E window. What is your outlook on FX, and by how much do you think this development will drive foreign investor participation?
Okay, well, let's start with the crude oil price thing you mentioned. If you notice, you find that even OPEC is beginning to review its decision to ease oil price cut because, according to recent reports, it's OPEC Plus's, the technical committee's projection of demand, for fuel is being tapered down from 5.9 million barrels per day. They are bringing it down to 5.6 and may even bring it further down, knowing that despite the wide campaign for vaccination against the coronavirus, we are seeing new strains and new hikes of infection in some jurisdictions. India, Brazil, the UK is still battling with infections. Even in the US, it's not yet totally convinced that the trend is now going down. There is still concern that coronavirus is still pretty much with us across the globe, and that is driving down the sentiment that demand will pick up. So global demand for fuel is still neither here nor there. It's still being estimated to remain largely contained, largely dwindling. And because of that, OPEC may not be very eager to push its policy of trying to drive prices up. So the cuts will remain. And even though that the cuts are meant to help push prices up, the demand drop is putting downward pressure on prices. So despite the fact that Brent crude has seen some losable amount of growth from January till now, that growth is remaining stagnant at this point. From 70, it has dropped back to about $66 per barrel and may remain around that corridor for a while until we are sure that the war against the pandemic is largely won. And knowing, taking it from there, you will find that Nigeria's hope to gain more FX, more foreign exchange through oil sales, that hope remains a bit curtailed. And therefore, you will find that the Central Bank of Nigeria will continue to have concerns, about a drop in external reserve, and therefore the capacity of the central bank to continue to intervene, in the FX market, that capacity remains constrained. And consequently, you find that our currency will either retain the value it has now or may even further depreciate. Let me not talk about devaluation because, we've been doing that technically. So I see the situation where the pressure on our currency remains largely high, and that continues to drive the inflationary trend we are seeing right now. And we don't see the end to that happening very soon. And that therefore calls for another, another call for the central bank to really sit down and push out policies that are not reactionary. Because most times we see central bank reacting to catch up in the market. And in that reaction, we keep depleting, we keep hemorrhaging, we keep bleeding. The little effects we have in our system, and non-oil export is not yet ramped up. So you find that we have to find a way. I keep saying this, and until it happens, we cannot get anywhere. A situation where there is a very huge gap between the realistic parallel market rate that most informal sector players have to source FX from, and the government acknowledged official exchange rate, now the I&E window. The gap is still so much, we can't do so well in that situation. And I keep insisting that the central bank has to find a way to allow more foreign exchange come in, in a freer market or in a market that mean more forces of demand and supply, even though the managed float may have to continue. But let there be an aggressive push to close that gap between the obtainable rate in the open market and the official rate.
Mr. Demese, you mentioned the inflation, and earlier you said it's still going higher. From 18 points, we're looking at 20, like you said, and that's quite scary. Are you saying there's nothing that can be done to curtail that, continuous increase of the inflation rate?
Things can be done to curtail it. Clearly, every problem has a solution. But it depends on the technocratic will of those who run this economy from both this fiscal policy point of view and monetary point of view to help cushion this situation. One, like I was just trying to say before you came in with this question, the central bank must open up all possible avenues for FX inflow. And the most substantial amongst that is the inflow of dollars that we get from export in this country, both oil export and non-oil export. It seems to me, from the evidence I've gathered, most exporters do not repatriate their money back to Nigeria. They do every smart thing they can do to ensure that they get their dollar exchanged in the wider, crazier parallel market at around 470, 480, in terms of transfers. And anything they can do, whether they keep the money, suspend the money somewhere abroad, and then sell it locally here and then wire it to where else. We know these things happen. Central bank has not come to terms with this. So one of the steps they must take is to see what they can do to encourage more exporters bring in their FX to this country. As I speak to you, millions or billions of dollars, hang out there without coming in here because the government policy, is not yet favorable to exporters. And that's quite paradoxical. Yes. When we are having the kind of crazy things we're having right now, every monetary authority or policy maker must find a way to encourage local players who export to bring in their currency down here. So they
All
must
right,
have to
Mr.
find a
Adomezwe.
way to make that high window rate very attractive for exporters.
All right, Mr. Adomezwe, thank you so much for joining us this morning, and do enjoy the rest of your day.
All right, thank you for inviting me. I thought
Thank you so
we had
much.
a few more minutes.
Thank you. Time has run off. Thank you so much. All right, still stay with us. AFEX Commodities Market Update is next in a moment. This is Business Morning.
Welcome back. Well, apart from just talking about commodities, AFEX is interested in inclusive and efficient markets in the commodities space, and this requires thinking of the full chain of activities that occur from production to consumption, and that's part of the discussion we are having at the AFEX segment. We have Mr. Yusuf Ogumbi. He's investment manager at AFEX. Thank you so much for joining us, Mr. Ogumbi. Good morning.
Great to have you.
Nice being here.
So what does a typical commodities value chain look like?
Thank you very much. So a commodities value chain spans from the production through processing, marketing, and then ends on the table of everybody. The best way to think of it about your maize and soybean value chain is to look at your plate of rice. So you see your rice, paddy rice, once I've gone through production, processing, marketing, and it's end on your plate. And you also see chicken, which comprises maize and soybeans. And then for the people that take malted drinks, you see a sorghum and malt and like. So that's basically your value chain before you. Must have gone through production, processing, marketing, and then it's on your table right before you to consume.
Okay. Well, for an investor, what should value chain management mean to them?
So for investors, it's critical because for each segment of the value chain, you have different problems and different solutions geared to solving these problems. So for an investor trying to approach any segment of the value chain, you have to evaluate each one of them independently before you bring it together. So for instance, if you want to go into production, you note the problems there, and then you approach it, solve the problems there so that you make your money, you make returns, highest returns. So it's critical to look at it, this broken down level before bringing it together and looking at the entire value chain together. It's critical.
So I am an investor and I'm hearing this, but it doesn't paint any picture. So I'd like for you to paint the picture. I'm an investor.
Yeah.
And you understand, I'm interested in the value chain. So just tell me, okay, you go here, you get this information, you do this, you do this, and then you get this result.
So for an investor, you understand that your greatest evaluation is the risk-return evaluation to take the investment decision. And then, for instance, you are going into the production value chain. You want to set up a plantation of oil palm, for instance. You have to recognize that the technicalities involved in selecting the breed that you have to plant, the technicalities involved in getting the labor you would use, and then how you would then sell whatever you produce from that plantation. Looking at it from that perspective, you've identified those problems just because you are looking at it from the production perspective. And then you can then target solutions. I have to identify the best breed to plant. I have to get the best hands to manage this plantation, and I have to design offtake contracts with my buyers so that I'm able to sell off whatever I produce and make my money off it. So if you also have to then integrate across the value chain, you identify that. You have a plantation, 5,000 hectares, for instance, and then you realize that selling independently might be a problem. So you then integrate into processing. And if you also realize that you have the capacity to do that, you integrate into marketing, whatever you have produced as well. Storage and all the likes, adjoining services, and you're able to develop a holistic solution for yourself just from identifying the production bottlenecks, processing bottlenecks, and then marketing bottlenecks.
Okay, so
basically.
How does AFEX approach the value chains of commodities in focus?
So based on looking at this systemic thinking, you identify that each person has its own peculiar problem, and then the solutions are geared as such. So for instance, in production, you identify that farmers are fragmented, dispersed, small landholdings. So a key solution is how can we bring them together? How can we bring these farmers, how can we aggregate them so that we increase their bargaining power, we increase access to markets, we increase access to finance. So that's the kind of that's the way we look at it. We also look at processors. We realize that they want to procure commodities, but then financing is a problem. Also, where to store it is a problem. So we target solutions as such. We also realize that we have exporters that get export contracts to sell these commodities outside the country, but then they also need financing. Then we design solutions across board to target each and every one of them, each and every stakeholder in the market.
So these are the opportunities that AFEX has made available in this value chain. So how do you
Correct.
present it? How do investors access these opportunities?
So investors also have opportunities across the value chain. So for instance, at the production level, you have what we call input notes. So input finance notes to finance farmers who are intending to produce maize, soybeans, and the likes. So you can invest against these notes on the exchange. You have your ABCP, asset-backed commercial paper that is targeted at the processors, and then they are able to also get the raw material they need to process the raw material they need. You also have the export finance notes that is geared towards the traders. Investors can also invest against this one across the value chain. So if an investor decides that the input finance note is not suitable to his own interest, it goes for the ABCP. If he realizes that the export finance note is more peculiar to him or her, he or she invests in such kind of product. So across board, you have a variety of options.
All right, thank you so much, Mr. Yusuf Ogumbi, the investment manager at AFEX. Thank you. But AFEX is still on. Now we now go to Michael Martins, who is in Abuja for the week ended 19th April. Total trade and number of contracts were up at over 1,000%. Michael, you have a lot of explanation to do this morning. You're welcome to the show, Michael.
Hi, Ini. Good morning. Thank you for having me once again.
Over 1,000%. Please tell us, take us through that line. I mean, we really like to understand.
So if you look at the commodities market summary, the total value traded on the exchange over the course of the week went up by 1,161% from around 0.23 billion to close the trading week at 2.9 billion naira. The total number of contracts traded on the exchange also went up by 1,304% from around 12,089 contracts to close the trading week at 169,774 contracts. The total number of deals, however, fell by 22.58% from around 31 deals to close the trading week at just 24 deals. The AFEX Commodities Index, which is the ACI, also fell by 3.09% from 400.14 to close the trading week at 387.77. We have seen no significant change in the AFEX Export Index, which remained unchanged at 159.35. With regards to the volume traded in the exchange over the course of the week, maize was the major culprit, which went up by a factor of 14 from around 11,000 contracts to close the trading week at just over 162,000 contracts. The other commodities that traded up this week were soybean, sorghum, sesame, and cashew. We are still seeing little to no volume for export commodities, ginger, and cocoa. The top and only gainer for the week with regards to the price of commodity contracts on the exchange was sesame, which went up by 1.05%, gaining 500 naira to close the trading week at 48,117 naira per contract. The top losers for the week are sorghum, maize, maize and sorghum, which went down significantly by 5.21%, 4.01%, and 2.74%. We also saw no change in the FETC, which remained unchanged at 13,962 naira per contract. And so that's by and large all of what happened on the exchange over the course of the week.
All right, Michael. So we saw a reduction in prices of sorghum, soybeans, and maize within the week in review. What drove that?
So, I mean, as we very often see with the commodities market, the bullish market doesn't continue forever. As we saw the bullish market play out in the month of January and February, we are seeing a fair bit of consolidation in the market in the month of March and April. But it's more so symptomatic of the procurement windows by all these major industry players. And with regards to the commodities in question, that's maize, soybean, and sorghum, we have what tends to happen is they procure a significant portion of their volume over the course of the year. They procure a significant portion in November, November and December, and then you see them procure smaller volumes in May and in January and February, and then you see them just sort of wait it out in the market again before you then see a reintroduction, usually around the month of May and June, into the commodities market. And you would also notice that some of those price decreases are usually not significantly more than 5%, indicating that they're just minor retracements and minor consolidations in the market and not fully indicative of a full-on bearish commodities market.
All right, so Nigeria's inflation rate for the month of March rose to 18.17%. I mean, we just discussed that. What are your thoughts on this in relation to commodities market?
Thank you, Ini, for that question. I mean, we have at different points in time over the course of this show spoken about the strong correlation between the commodities market and particularly the food inflation. A bit of the analysis that we did at our firm sort of indicates that that correlation might be as strong as 80 to 90%. So the commodities market sort of indicates, serves as a leading indicator of what you'd eventually see reflected in the inflation rate. But speaking generally, but more so speaking generally from a macroeconomic point of view, I think there are a couple of other factors that are contributing to the numbers that we are seeing reflected in the inflation rate. The first of which would be an increase in money supply that we've seen over recent months, right, with the reduction in inflation and in interest rate and some of the intervention that we've seen by the central bank. And secondly, which I believe would speak more to the food inflation numbers that we're seeing, is the structural issues that we had in the food value chain out of last year, with the COVID-19 affecting production numbers as regards to distribution of inputs to farmers, and also the reduced rainfall that we saw play out last year across the major grain producing regions, with the northwestern region being the only exception, as that would be the second factor. The third factor would be the exchange rate adjustments that we also saw last year, leading to higher commodities, higher prices for starting commodities at the beginning of this season, essentially making commodities more expensive to buy. Fourth, which I think also slightly speak to some of the inflation numbers that we're seeing, is the instability in the petrol prices that we're seeing, and also the removal of fuel subsidy that we have seen contemplated by the federal government in recent months. So that, and we're all aware of how that eventually feeds into food prices. I mean, my Uber driver yesterday was complaining that he had to buy fuel. I don't know how true that is, at 400 per pump price. And I have a colleague at work who recently complained that the price of agege bread is not 500. So when you evaluate the collusion of all those factors, right, from money supply to the structural issues in the food value chain last year, to the exchange rate adjustments that we saw all of last year, and also to the instability in the petrol prices, it's not uncommon for you to surmise that the inflation numbers that we're seeing, they're only just starting and they will continue. They are expected to continue upwards. And it's more so the case for why people should actually be invested in the commodities market, because the commodities market serves as a significant edge against inflation. So if you're seeing higher inflation numbers, it's the case that you will see higher return on investment if you're invested in the commodities markets, particularly with spot contracts and maybe even with fixed income notes. So for people that want to get invest in the commodities market, we very often advocate that they go to our website, which is www.afexnigeria.com. And also, if they want to get involved trading commodities, whether that's spot contracts or fixed income note, they can always download our COMEX app, which is available on Android and iOS.
All right, Michael, thank you so much. I'll be an investor as long as you promise me profit. Thank you for the update, Mike. All right, we'll take a moment now. When we return, Business Morning returns in a moment. Just stay with us.
It's now time to do an opening call to the market with Edidiong. And, well, it's been a good week so far. First, 0.1 up to yesterday, 0.43. 0.43 up yesterday. I just keep my fingers crossed and hope that it continues.
Well, Ini, you're right. I mean, the market started on a positive note. We saw those positive sentiments continue yesterday, and that was largely due to buying interest in bellwether stocks. We saw some interest in MTN Nigeria and in Zenith Bank. For some days now, we've seen the banking sector posting gains, but we'll continue to watch and see what happens. I don't want to get my hopes up yet, but then anyways, let's just see what happens in that space. The market was up 0.43% at 39,015.58 points. Yes, we've gotten back to the 39,000 psychological level And hopefully we'll just keep getting higher from there. The equity cap was at 20.481 trillion. And now the month-to-date returns moderated to minus 0.1%, while the year-to-date returns moderated to minus 3.1%. Volume, value, and deals traded yesterday were lower compared to the previous session. Now, it wasn't out of the ordinary because on Monday we saw unusually high volumes, values, yes, on the market. But yesterday we kind of like moderated back to the regular levels. 339.03 million units worth 2.70 billion naira traded in 4,205 deals. But for more on the market, let's talk to Phil Anigbe, a research analyst at Cardinal Stone Securities. Good morning, Mr. Anigbe. Thank you for joining us on the program.
Yeah, good morning, everyone.
So what's really driving sentiment on MTN and this positive sentiment we've seen from the start of the week, how long do you think that will be sustained?
Well, for sentiment across the market, I think major drivers could be reactions to earnings releases, as is the case for the banking stock. We know UBA just released its Q1 report that was largely positive. We saw improvements in interest and non-interest income as a result of moderation in lending costs, as well as improvement in fee and trading gains. Besides that, we are seeing active offshore accounts to invest some of their dividends, and that's providing some support to the market. And that could be linked to CBN's resumption of FX sales. Broadly, we are thinking that domestic demand for lenders still remain robust, and we are likely to see big pieces of that for this week. For GC, we've seen notable foreign interest in the stock as well. For this week, we are thinking that activities will remain at these levels. You will continue to see some decent activities across those names, as well as some bargain hunting activities for investors that see opportunities to cherry-pick fundamentally strong names. The key risks that we see include elevated interest rates and, of course, potential reactions to CBN's imminent, or we don't know if it's imminent anyway, but they are now saying that FX could be restricted for the importation of sugar and wheat. That could drive some activities, negative activities for the likes of flour millers and those involved in sugar production.
All right, Mr. Anigbe, thank you for your input on the program. Phil Anigbe is a research analyst at Cardinal Stone Securities. I'll just look through the market now. Fidelity Bank was the most traded stock by volume, while GT Bank was the most traded by value. For sectoral performance, was broadly positive. The banking sector was up 1.75%. Now, we saw gains from GT Bank, from Zenith Bank, and from UBA. Zenith Bank was up over 2% yesterday. GT Bank was up by about 1%, and same with UBA. For consumer goods, it was up 0.38%, and we saw 10% increases from honey flour and from PZ yesterday. So those were what really helped that market. The industrial goods segment was unchanged. It was also unchanged in the previous session. We haven't seen any movement from the stocks on that counter. Insurance was up 1.12%, while oil and gas declined 0.22%. For the unlisted securities market, we also saw some profit taking because that market has been on the rise lately. It was down 0.39% yesterday at 762.37 points, while the market cap was at 551.90 billion naira. We saw about 28 million units worth 464.24 million naira traded in 32 deals. Now, the bond market continued it was mixed yesterday. We saw yields at the short end of the curve expand, while yields at the mid and the long end, or rather, we saw yields at the short end of the curve decline, while we saw yields at the short and the mid and the long end expand. There are 24 deals worth 28.60 billion naira in that counter. The Nigerian Treasury bills market was also bearish, but a bit quiet. We saw 8 deals worth 739.28 billion naira in that counter. The CBN special bills market, we just saw 6 deals in that segment of the market. While the OMO market, we saw yields in that space rise. However, it was a bit quiet. There were 10 deals worth 102.11 billion naira. But today, I mean, investors are just going to be paying attention to the bond auction. There will be a bond auction today, and we're expecting focus to be on that. But for expectations on that, let's talk to Chioma Udu, a fixed income dealer at GT Bank. Good morning, Chioma. Thank you for joining us on the program.
Thank you for having me. Good morning.
So what are your expectations for the bond auction today, and how's that likely to shape trading?
We're going to see a very quiet market today in anticipation of the bond trading. Bond auction we have today. Most of the dividends is on offer across street tenors on the 2027, 2035, and 2045. We expect that rates are going to close to the current market rate. This is currently at in the range of 12.2 and 13.95.
All right, Chema, thank you for your input on the program. Have a lovely day. Chema Udu is a fixed income dealer at GT Bank. Well, just like I had said, and Chema said the same thing, the market is expected to be quiet today while investors just pay attention to the auction. So we'll see how, that turns out and how that will shape trading for the rest of the week.
Yes, and we hope that our favorites will keep staying in the red for the week. All right, Eddie, thank you so much. We'll take a short break now. When we come back, we'll head to London. Welcome back to Business Morning. We now head to London where Juliana is waiting, and we have some data from London. Good morning, Juliana. So UK.
Good morning, Innie.
Good morning. UK inflation is up. What other data do you have for us, and how's that going? What's driving that?
Yeah, well, price growth is on an upward trajectory in the UK, and it could remain that way for some time now. So in the 12 months to March, UK inflation rose to 0.7%. That's up from 0.4% in February, which is quite a significant jump, though still way off from the Bank of England's official target of 2%. There are several factors, really. One of them is house close prices, which has risen significantly over the past couple of weeks, as well as the price of fuel. And what we're going to be expecting much later in the year is that we're going to see a rise in oil prices and energy. Ofgem, which is the energy regulator here in the UK, last year announced that they'll be raising their tariff for energy here in Britain. That starts at the end of this month. And of course, we are talking about it quite extensively on this programme, the opening of non-essential retail, which took place on the 12th of April. So even though we've got 0.7% in March, we could go to more than 1% in the month of April.
Well, another threat to the UK job market if Sanjeev Gupta fails to find a new lender. What's the latest on this?
Well, it's a pretty complicated and expensive web that's been tangled. It all goes back to the collapse of the pretty disgraced financial firm Greensill Capital, which is embroiled in a row between ministers and Downing Street at the moment. But I think for the British government, what's more important is trying to save Liberty Steel and those 5,000 British workers that do rely on that company staying afloat. Now, the government have always insisted that they do want to save Liberty Steel in some way, shape or form, but they are concerned about its owner, Sanjeev Gupta, who, after buying a home for £42 million in London, a couple of days later asked for a bailout of £172 million from the British government. The two don't really tally. The business secretary, Kwasi Kwarteng, has spoken quite extensively about this on British media, saying they do want to save these jobs, but the business dealings of the Gupta family are pretty opaque, and so the government have got to be careful about how far they try and save Liberty Steel, because of course, even though it is the government that are going to be signing the cheque, it is the taxpayers that ultimately will be paying for this.
And there's climate change in the news. Meeting the target of zero emissions by 2050 is the buzz among finance firms in the UK now. What are they doing?
Well, what they're trying to do is hit these targets. COP26 is taking place towards the end of the year in Glasgow, and this is really a chance, an opportunity for Boris Johnson and Rishi Sunak to put themselves head and shoulders above the rest of the world in being a cleaner, greener economy and to trying to hit these net zero targets. Now, the government have said 1 in 3 of the Britain's most profitable firms on the FTSE 100 are trying their best are paving the way to try and hit these emissions. And there's a couple of things they're doing. I won't waste too much time, but Sainsbury's, for example, have committed £1 billion over the next 20 years. And as part of their pledge, they're going to be reducing food waste, plastic packaging and water usage. There are several methods that different companies, especially finance firms across the UK and within the square mile, are trying to be cleaner and greener. And Boris Johnson is certainly happy to be showing off some of these examples.
All right. Thank you so much, Juliana. Thank you for all that information, and enjoy the rest of your day and get ready for Ladi in the afternoon. So now up to Ladi. Ladi, I hope the bloody streets have turned to a greeny street this morning.
Well, looking at Coin 360 map, yeah, it's green.
That's good.
We have a bounce now. $55,000 this morning. Bitcoin, Ethereum, 2,300, up about 9.96%. So we have a lot of green here. Only Dogecoin here. Dogecoin, it's had an incredible run, but down about 19% this morning. Yesterday was Doge Day, but today is not Doge's day. Market cap 2.05 trillion, up about 4.17%. We have Gilbert Jopata now, our digital market analyst. Hello, Gilbert.
Yeah. Good morning, Ladi.
Good morning, Gilbert. Yeah, we've had a pretty volatile weekend, you know, and this market has a way of taking back the profits made by traders. So I'm wondering, how do traders protect their profits at this point?
Okay, market pullback is a common thing in a bull market. And this is where good money management is needed. So you take profits, a trader can sell a portion of his or her gains made to stable cryptocurrencies like USDT. This will help such trader protect such profits. It's more like locking your gains. And it will also give you an advantage of buying more dips, which means once the market recovers, you'll be at more profits. But to lock in your gains, you need to make sure you sell your profits to USDT.
Well, now, Gilbert, the problem is you don't know when these dumps are actually coming. So how do you know when to, go into the stable coins? How do you anticipate, these dumps?
Okay, if you look much into the technical side of trading, you will want to be selling at resistance, whether you're using your basic support and resistance or trend lines. But for somebody who is not knowledgeable about technical analysis, such person could always sell once such trader is at profit. Once you are at profit, you sell off or you sell a portion of such profit to stable currencies.
All right, so basically, you get the kind of profit you're comfortable with, even though it goes, surpasses that, just be comfortable with whatever you have.
You have profit anyway. Don't let greed stop you from taking profit when you have it.
All right, Gilbert, thank you so much for your time. Do enjoy the rest of your day. All righty, there you have it.
Yes. So Gilbert said, don't get greedy.
Don't get greedy. Yes.
Don't get greedy. So once
don't get greedy.
I think you set a mark, you know, and then you just, once you hit that, then you put it in the save the USDT, like I said.
Exactly.
Or you cash out. Because
most traders believe, maybe it might go maybe another 100% or another 1,000%. Traders are so optimistic in this market, but you need to be smart.
You need to be smart and not be greedy. And always remember that this is a very volatile market.
Very volatile.
And you need to really watch it.
And you need to get professional advice before you get into this market. Yeah.
All right, well, that's where we'll draw the curtains on the program today. Thank you so much for watching. I'm Ini John Mekwa.
And I'm Ladi Williams. Thank you for watching.